Today, we are going to look at a case study where an individual is moving a total of $1 million into a whole life insurance policy. We'll go through first the reasons why he's interested in a whole life insurance policy and why he's moving $1 million into a policy. But then two, we'll look at different products. We'll look at different companies. We'll look at different features and benefits that are offered with different whole life insurance products. Really, what we'll cover in today's video is what we cover with a lot of individuals. This video is well suited for you if you're someone who really likes the information. If you are very analytical or technical and you want to understand the different options available and why policies function in a certain way when you've got a goal of first maximizing the cash value and then using the cash value. That's often what people like to do. How do I maximize it first and then use it second? That's what we're going to cover. And this is a case study based on someone who recently reached out to us that has a technical background, very sharp individual, likes numbers and such. So hopefully this will speak to you as well if you like the details and the nitty-gritty numbers. So let's get on into it and have some fun. What we will begin with is what he wants to do. So he's interested in moving 7 figures into a whole life insurance policy. And here's the first thing he mentioned. He wants to use the cash value, firstly for his business, and then secondly, possible real estate. He's also interested in the death benefit. However, he wants it paid to his trust. This is common. If individuals have a trust set up, typically that trust specifies how their assets should be paid to their beneficiaries if something were to happen to them. So it is a common strategy for many to designate the beneficiary of a life insurance policy or multiple life insurance policies as a trust. For example, if I have a trust listed as a beneficiary, I die, that death benefit is paid income tax-free to the trust, and then the trust states exactly who, how, and when received the money. So we can control exactly how those funds are paid out, which a lot of people like to do to really maintain generational wealth. It prevents a young child from receiving a large tax-free death benefit and then going and getting something really cool like a Ferrari, which I'd wait until you're older and more mature and then really think about doing that. But anyway, I'll talk about cars the whole video, so I'm going to continue on to the actual facts here. We've got a 39-year-old individual. What he's interested in right now from a funding perspective is this. He wants to move that total of $1 million, but he wants to do it over 5 years at $200,000 per year. So when I see or hear this, I've got questions, and there are also some items that I want to make him or anyone aware of as you begin to see different companies and products, because the last thing we want for anyone, and where I frequently see buyer's remorse occur in the industry, is when someone's interested in something like this, a whole life insurance policy with a large dollar amount going in. They see an option, they like it, they move forward, but then they see a different option later on that they express, hey, I would have liked to have seen that. I may have gone with that option, but I didn't even know it existed. So it's always that fine line. How do you show enough options where someone sees everything and they can pick the one that they really feel is best for them, and we can provide advice as well, but then at the same time, not overload them with 18 million options, which is a fine line because some people like to see all the options, but some people do not. But anyway, questions help refine that from the get-go. If I ask the right questions, now I know I can show perhaps 2, 3, or maybe 4 options instead of 18 options, and then providing awareness. So company selection, 4 major mutuals. When it comes to a whole life insurance policy, where cash value is the goal, what we've seen is that the 4 major mutual companies have a track record of consistently delivering the strongest actual cash values. And when it comes to using the cash value, my belief is if I wanted to borrow against my policy, why on earth would I not maximize the cash value first? Because then I've got more money to work with. Your 4 major mutuals are Mass Mutual and Guardian, and the other 2 are New York Life and Northwestern Mutual. Product choice. We're going to look at 2 main products, a Mass Mutual 10-Pay and a Guardian L95, which are great for premium flexibility and maximizing the cash value. And we're going to look at values based on the present dividend rates, We'll also look at some guaranteed values. It'll be interesting when we look at that. Funding flexibility. This one is huge. And we went through this in detail on the shorter video, which you can check out up here. But this is very important, really, when we're looking at different companies. And then policy loans. This is something that we like to model heavily, meaning if you're considering using policy loans and looking at a model, what that model should show, in my opinion, is when I borrow against my policy, what's the impact that that loan has on the policy? So how much can I borrow? Whatever I have in cash value. When I take a loan, I see my cash value drop. That's my available equity that I have access to. However, I continue to earn dividends and interest on my entire cash value, meaning money that I have not borrowed, still remaining in equity, and the cash value that I have loaned against the policy. I'm still earning dividends and interest on everything. How the company does that is, one, they do charge loan interest on the amount I have loaned, and then two, they do collateralize the death benefit dollar for dollar. So if you had a $500,000 death benefit with $100,000 in cash value, you borrow $50,000, what'll happen? You'll have a cost to borrow, loan interest due on the $50,000, but you'll continue to earn dividends and interest on the full $100,000, as if you were before you did not take the loan. How much did you borrow? The $50,000. Your death benefit pre-loan, remember that figure? It was $500,000. After you take that loan of $50K, your death benefit now drops to $450. And if you pay it back, you see your values restored, plus the dividends and interest you've been earning over time. But people are interested in that because my money continues to compound. That's the advantage there. How quickly can I access loans, especially for business owners or people involved in real estate? This is very important. Time is money. Typically, you can get funds very, very quickly in 3 to 5 business days, usually direct deposit. Let's hit on funding flexibility because this is a big one. So he wants to fund what with his policy? This is you. You're looking to move in $1 million over 5 years. That's $200,000 per year. Both MassMutual and Guardian can be designed like what we have here. So anytime we look at a life insurance policy and cash value is the goal and we're looking at funding flexibility, my question to you would be this: where is your money going? Because you can choose how much of your money goes toward the premium piece that you'll notice will not show up in cash value right out of the gates. And then how much goes toward your PUA rider. PUA stands for paid up additions. This is really how we overfund a policy and maximize the cash value. So the first question is where? Let me show you how to identify where your money is going. So when we look at an illustration here, let's take a look at MassMutual first. Here we go. So he is 39 years old, under year, or right next to year, you'll see his age of 40. Notice what the illustration states, age end of year. Some companies will show your age at the beginning of each year, and then some will show at the end of each year. Here with MassMutual, at the end of each year, they're showing how old you are. So you started out at 39, and then at the end of the first year, you were 40. So $200,000, here's your annual outlay, $200K per year. Where is the money going? Up here, where you see base policy insurance. Guess what that is? That's your base premium, $20,000 at 10% of the total desired payment. Then we've got LISR, LISR. That is a combination of money that goes toward a term rider and then money that goes into PUAs. This is a key rider to attach to a policy when we are making it very, very flexible. If you have this attached, you can easily adjust payments one time per year without any medical underwriting. Very beneficial to have that rider. Then we've got scheduled AILR, which is just MassMutual's term for their pure paid up additions rider. Here, 160. Then we have another term rider, renewable term rider. Purpose of that, cost-effective way to add more death benefit, which you may know this term, raises the MEC limit on a life insurance policy, which is that taxable line. What are the core benefits to the cash value of a life insurance policy? Safe, liquid, and tax-free. Tax-free if we do not trigger a taxable event, such as a modified endowment contract. The MEC limit on this example is $200,000. All right, so in this example, we see 10% toward the premium. We've got term riders attached as well, but I've got a low premium relative to what the company will allow. The limits will allow me to go just about as low as 10%. You'll see a little bit lower on the Guardian examples. It's closer to 9%. But 200 in, cash value, just about $180,000. That's about 90% of your payment available in the first year. If I'm all premium, or if I have a higher base premium, I'll see that cash value end up being less than the 90% here. Typically, if a policy is designed with a minimal premium, I should see my cash value somewhere between 80 and 90% of my first year payment. The break-even point should typically fall somewhere between years 3 and 6, again, depending on the company and product. Here, it's year 4, where 200,000 times 4 years is $800,000. That's his cash value. And then it continues to appreciate over time. However, this is based on the company's present dividend interest rate of 6%, and that's going to change over time. Illustrations are really valid on an annual basis when we look at it. As time passes, we always want to look at a new in-force illustration, which just shows what our policy will look like the next year, and so on and so on. What does the performance look like each year? We want to look at a fresh illustration. So that's MassMutual. As we look at Guardian, guaranteed values, the non-guaranteed values, current. Current represents the present dividend rate, 5.75%. But going back to that main question, where is my money going? 200,000. Here's your premium. And you've got your paid up additions rider. Look at that. What do you notice there, the difference? That PUA rider is literally 10x the base premium. That, by the way, is the maximum amount we can illustrate. That's how low we can go in the premium, with the exception of the first year, where we can actually go up to 50 times the base premium in PUAs if we wanted to. But after that, the most we can illustrate is 10x annually. Now, something to be aware of, looking at these guys, is this PUA payment first covers the cost of the term insurance rider. Just like Mass, purpose of a term rider is to add more death benefit, which increases your MEC limit. That's the main goal there. But that is not all going toward PUAs, that payment. At first, satisfies the term cost, and then everything else is dumped into PUAs. But we've got the guaranteed cash value. When's your break-even point here? Just about year 6. That's attractive, by the way, for the guarantees. And this is a product with a guaranteed rate of 3%. Year 7, there he is. If he gets preferred plus, this is just regular preferred. Preferred plus is going to get him very close to year 6. And then based on the present dividend scale, he's between years 3 and 4, which is attractive there. So high liquidity up front. And then also, we've got this indexed illustration, which we're going to hit on in a little bit shortly, which is a rider we can attach to a whole life insurance policy, which we do not have to use. If we never use it, it functions like a basic whole life insurance policy, the example we just looked at. But if we do elect to use it in some years, what we're doing is electing to allocate some of our cash value, or all of it, to the S&P 500 index. It grants for a little bit greater earning potential on a whole life insurance policy. I would check out this video for more information on it. But we will look at a comparison as well. Let's continue on here. Funding flexibility. Where's the money going? We just went through how to identify it in an illustration. Here's the other big thing. Flexibility. This is huge. So if he's comfortable funding the $200,000 per year, every year for 5 years, and he's already got that money in cash, he says, hey, I don't need much flexibility. I'm going to write a check every year, or I know I'm going to have it. Like I'm not too concerned about that. MassMutual works beautifully. And he does have some flexibility as well. He can easily make payment adjustments 1 time per year without medical underwriting if he's got that LISR rider attached, where we mentioned it was very important to have that flexibility. But 1 time per year without underwriting, provided it fall on his policy due date, which is another name for his anniversary date. But being comfortable with that one time per year payment and the adjustment is really the key in that case. Whereas Guardian, on the other hand, what it can do is commit just to the minimum, which is that premium of $18,000 and change, plus the term rider. Let's just round up to $20,000. He can pay that yearly. He could also break that up over 12 months if he wanted to. If he said, hey, I want to pay the minimum monthly, and then 100% at his leisure, he could just add funds into PUAs. So if you like the idea, if this is you, if you said, okay, my target dollar amount to get into the product is $1 million over the next 5 years, let me set it up where I can just commit to the minimum so it does not feel like a burden to me. And then at my discretion, I'll add more funds into PUAs through an unscheduled PUA rider with Guardian. That can be through your online portal, mail in a check. Again, very, very flexible. But there's a difference there. I'm going to ask about that. How much flexibility would you like? Here's a slight difference with MassMutual and Guardian. Regarding the funding flexibility, do you have a preference? Or is one more appealing to the other? Or do you think that this will be useful? No, I've already got the money in cash. Okay, Mass or Guardian works perfectly fine. You know, I'm counting on that money coming in, but in the past, things have not been that, the money has not always hit. Well, in that case, Guardian might work better. But a small detail there that's very, very beneficial to be aware of before starting a policy. So let's look at a comparison here, and we'll go through some items people like to look at when comparing. So what we've got first, on the left, the 10-pay illustration we looked at. Then two Guardian options. It's the L95 policy, but with a 10% PUA fee and a 5% PUA fee. The 10% PUA fee. When we look at the non-guaranteed values, assuming the current dividend rate holds forever, what you will find is with a 10% PUA fee, you'll have more long-term value. And that's based on the cash value and death benefit. The 5% PUA fee, it's usually about the first 10 years, sometimes the first 12 years, call it 10 to 12 years, where that 5% PUA fee has greater value than the 10%, but then from that point forward, we see more of the 10%. Guaranteed values is a different story. If I'm very conservative, I'll see the 5% PUA fee deliver greater cash value and death benefit short-term and long-term, which is very beneficial to be aware of. This is why we like to show both. It's not just, in my opinion, not just a case of saying, hey, this guy will give you more long-term. Potentially it will. However, when we look at the guarantees, that is not the case. So here we've got a comparison. What's highlighted in yellow represents the break-even point, and we can match that up with our total funding. But a report people like to look at sometimes, including myself, is the cash value growth and the total gain. So let's take a look here. Here we go. So here's what we've got. And again, this shows you net what you're receiving from the insurance company. First year, you're paying $200,000. Your cash value is $179,000. There's your death benefit. Your yearly cash value growth was negative $20,000. Dividend rate, 6% with MassMutual. Your cash value growth was negative $20,000. You did not gain anything in the first year. A lot of times, individuals feel that they begin to earn dividends and the guaranteed rate immediately. It is true that from day one of starting a policy until year end, the end of the first year, I may see some cash value growth. So for example, this could start out at 175 and then hit 179 by the end of the year. However, how I look at it is I paid in 200 grand and I've got about $20,000 less than what I paid in. That's what the yearly growth is that particular year. Second year, I'm at 179. I pay in 200. Now I'm at 373. If I was earning 0%, I'd be at 379, meaning I took a loss again. It's minimal relative to my payment, but it's about 6 grand. How about the following year? Paying 200,000, you were 373. Now you're 583. If you just add another 200 to it, you'd be at 573. So you got that back plus another 10. There's the cash value growth. See how that works? And then with the total gain, this one's easier, as it's just going to look at your total funding, the cash value, and the difference will be in this column. For example, year 3, negative $16,000 and change, because you've paid in $600, you've got $583 and change, the difference, negative 16. Look at year 15. You've paid in $1 million, you're at $1,669,000. There's the cash value difference, or the gain, just about $670,000 when we look at it. And you'll see the same with the 2 Guardian options. Let's look at the same thing, but with percentages. Internal rate of return, which in my mind is great to look at because the dividend is a gross rate. Often people want to see the net, what is the net growth rate, and the IRR is what insurance companies often use, and you can request it in an actual illustration so you can see it on their paperwork as well. That's why I'm a big fan of it here. It provides transparency. But I see the same thing. The annual IRR is just displaying what the policy is growing by net each year, and the average IRR is taking into account all years. So if you look at year 10 on the Mass Mutual example, you've paid in $1 million over 5 years. Cash value is 1.3, which comes out to a 3.35% average internal rate of return. Let's look at this real quick. So from a lot of information here. From a flexibility standpoint, is there one company that you prefer over another? Just from your research thus far. And if you don't know, typically people who have the funds in cash or are very certain they will have it will gravitate toward Mass in many cases because you don't need that flexibility. However, if they want the flexibility or they just like the idea of it, Guardian's attractive there. So Guardian. We've got the 2 options, the 5% and 10% PUA fee. We had mentioned that 5% PUA fee has greater guaranteed values. So underneath what you see in red, guaranteed values. On the left, you've got the 10% PUA fee. On the right, the 5% PUA fee. This column will tell you everything you need to know. What do you notice here? Right out of the gates, you've got about $9,300 more in cash value with the lower 5% PUA fee. And again, this is based on the guaranteed values. By year 5, when you've paid your $1 million in, $49,000, almost $50,000 more. That's significant. How about by year 20? If we look at this a little bit longer term, and the death benefit's not appreciating here, it's not increasing because there's no dividends being applied here. But we see how much more you have in cash value indefinitely with the 5% PUA fee. And we can scroll down, but you'll see it continue to appreciate. Whereas over here, what do you notice? 5% PUA fee has more for about 10 years. Then from that point forward, that 10% PUA fee has significantly more in value. Then what we'll also look at is a demonstration of the indexed rider, which is pretty neat. But what I like to do here is compare the basic dividend with the indexed rider so I can see them side by side. And what you could also do here, if you want to be a little bit more creative, is look at an illustration that shows 50-50, meaning 50% of her cash value is tied to the S&P and then 50% is tied to the basic dividend. There is that fee we have to be aware of when we turn the indexed rider on, which the illustration does reflect. However, the illustration, when I'm looking at the index strategy, it's just back tested. It's based on the past 20 years of what the S&P 500 did, based on the index strategy, meaning if the market goes down, you don't lose any principal. But with all of that said, it's based on past results. Who knows what will actually happen? But we've got that, and then we've got our loan workbook, which we looked at in our last video. What this demonstrates is a $500,000 loan. This is actually based on the Guardian 10% PUA fee. We paid interest only for 2 years. Then we begin to repay it at $100,000 per year. But here's really what people like to look at. Yearly cash value growth compared to what I'm paying in loan interest each year, compared to the total gain on cash value and the total interest payments. So I can see each year, am I positive or negative? Meaning, am I receiving more from the insurance company or am I paying them more? That's a big point of interest when we're trying to understand from a numbers perspective, do policy loans make sense? So I hope you enjoyed this one. I had a ton of fun with this video. If you have any questions, please let us know. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.